Today, we're going to tackle a topic that can be a real headache in international trade finance: the difference between UCP 600 and ISP 98. Now, I know these sound like technical acronyms, but understanding them is absolutely essential. Getting this right means your transactions go smoothly, but a misunderstanding here, well, that can cause some very expensive problems.
So, let's just start with a question that might sound a little strange. Did you know that some letters of credit are actually designed to be used only when a business deal completely falls through? Yeah, it seems to go against everything you'd expect, right? But believe me, once you grasp this single idea, the whole world of trade finance starts to make a lot more sense.
You know, it's a super common source of confusion for anyone starting out. You hear letter of credit and you see these two different sets of rules and you think, why? Why complicate things? Well, the truth is they're not for the same thing at all. And my promise to you is that by the time we're done here, you'll see exactly why both of them need to exist, and you'll be able to spot the difference between a payment tool and a financial guarantee from a mile away. So here's our game plan. We'll start by getting a solid handle on UCP 600. That's kind of the main player in this space. Then we'll look at its counterpart, ISP98. After that, we'll put them right next to each other to really highlight the differences, and we'll finish up by answering a few really important questions that tend to pop up. Okay, let's get started with the one you've probably heard of, UCP 600. The best way to think about this is as the rulebook for when everything goes right. It's all about making sure a trade happens just as planned, and, most importantly, that the seller gets paid.
UCP 600 stands for Uniform Customs and Practice for Documentary Credits. It's a mouthful, I know, but its job is pretty straightforward. It sets out one single set of rules that banks all over the world follow for what we call commercial letters of credit. These are the instruments that make international trade possible, building a bridge of trust between a buyer and a seller who have likely never met.
If you're looking for a simple analogy, a commercial letter of credit is kind of like an escrow service, but managed by banks. The bank holds the buyer's promise to pay. It then releases that money to the seller, but only after the seller proves they've shipped the goods by providing the right documents. So the key takeaway here is that payment is the whole point. It's the expected happy outcome of a successful deal. And the process itself is actually quite logical. First, the buyer's bank issues the letter of credit, which is a rock-solid promise to pay. Once the seller has that promise, they can ship the goods with confidence. Then comes the critical step. The seller takes all the shipping documents, the proof, to their bank. And finally, the bank meticulously checks every single detail on those documents. If everything lines up perfectly with what the letter of credit requires, the bank pays the seller. It's all about the paperwork.
And I really can't stress this enough. This entire system is driven by documents. Not the actual physical goods, but the paper that represents them. UCP 600 is very, very specific about this. We're talking commercial invoices, bills of lading, insurance papers, you name it. The bank doesn't care if the goods are blue or green. They only care if the documents say they are blue, just like the contract specified. Get one detail wrong, and the whole payment can be delayed. It is all about strict documentary compliance.
Okay, so that's UCP 600, the rulebook for successful payment. But now, let's just flip that completely. What if you're not worried about paying for goods? What if you're worried that the other party won't perform their duties at all? Well, for that, you need a different set of rules. And that brings us to ISP98, which I like to call the financial safety net.
ISP98 is short for International Standby Practices, and these are a completely separate, specialized set of rules for something called a Standby Letter of Credit, or an SBLC. Now, this is not a tool for payment, not at all. A Standby LC is a financial guarantee. It's there to protect you if the other side of the deal fails to live up to their end of the bargain.
And this is the most important difference to remember. A standby LC is a safety net that, ideally, you never have to use. It's designed to just sit there. It only gets activated if something goes wrong, if a builder doesn't finish a project on time, for instance. So with a standby, getting paid actually means something bad has happened. It's compensation for a broken promise, not a reward for a successful transaction.
Since its purpose is so different, the required paperwork is, well, it's night and day compared to UCC 600. You can forget about all those complex shipping documents. To make a claim on a standby LC, you usually only need a formal demand for payment and a very simple statement that says the other party has defaulted. That's it. The focus is purely on the failure to perform.
Okay, so we've looked at the payment tool and we've looked at the safety net. Now, to really make sure this is crystal clear, let's put them side by side and compare them directly.
First, let's look at their core function.
It all comes down to this. UCP 600 is for payment. It's the primary way to make sure money changes hands for goods in a successful trade. ISP98, on the other hand, is for a guarantee. It's a secondary plan that pays you compensation when a deal goes bad. One is for success, the other is for failure.
And that difference in purpose leads directly to the difference in paperwork. UCP 600, because it's about physical goods, needs a whole stack of complex documents to prove everything was done correctly. But ISP98, since it's only about a broken promise, just needs a very simple, direct statement saying, hey, they didn't do what they promised, so please pay me the guarantee. It's complex versus simple.
So you might wonder what happens if a standby letter of credit mentions both sets of rules. Which one has priority? Well, the rules are very clear here. UCP 600 is for general trade. Its rules just don't work for guarantees. That's exactly why ISP98 was written, to be the specialized tool for the job. So in any kind of conflict, the specialized rules of ISP98 will always prevail.
Thinking about these specialized rules actually leads to a couple of really common questions that people have, so let's just tackle those head on.
A really fair question to ask is, look, if everyone was already using UCP 600 for letters of credit for decades, why bother making a whole new set of rules?
And the answer is pretty simple. UCP 600 was just the wrong tool for this specific task. All of its rules about shipping documents and invoices are totally irrelevant when you're dealing with a performance guarantee. And maybe even more importantly, UCP 600 had no rules for unique situations that happen all the time with standbys, like something called an extend or pay demand. A dedicated rulebook wasn't just a nice idea, it was absolutely necessary.
Okay, and this leads us to the next big question. Let's say a standby letter of credit is issued and it accidentally mentions both UCP 600 and ISP98. If there's a disagreement, which set of rules gets the final say? The answer here is definitive. ISP98 always wins. It's a global banking standard. The specialized rules, the ones that were tailor-made for guarantees, will always take precedence over the general rules that were designed for something else entirely. This creates the certainty that you need when you're relying on a financial guarantee.
All right, we have covered a lot of important details here, so let's just take a moment to boil it all down to the most important takeaways.
If you remember nothing else, remember this. UCP 600 is for commercial LCs, and it's about payment for goods, which requires complex trade documents. ISP98 is for standby LCs, and it's a guarantee against failure, which only requires a simple statement of default. Payment versus guarantee. Complex versus simple. That is the fundamental difference.
In the end, these two different rule sets are here for a reason. They solve two very different problems in the world of commerce. But as we look to the future, it does raise an interesting question. With everything going digital, how might things like electronic bills of lading or even blockchain technology change these rules, which are so heavily based on documents? I'd genuinely love to hear your thoughts on that, so please share your ideas in the comments section below. If you found this useful, a thumbs up is always appreciated as it helps others find this content. And of course, please subscribe for more deep dives into the world of finance. Thank you so much for watching.
Stay ahead in the world of global commerce. Subscribe to Vanijja for expert analysis. And don't forget to like this video.